Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, 7:30 Mountain Time on April 21st. This is the abbreviated video version summarizing our weekly note, which was titled "The Fed is Fattening the Recession Tail." Guess it was a somewhat provocative note. We got some correspondence this weekend strongly supporting or defending the Fed, and others on our side of the coin, which is the Fed is fattening the recession tail by being obstinate and perhaps digging in Powell, Chair Powell, that is, digging in his heels around Fed independence. So the note really is all about the policy calculus. We've talked a lot about how trade policy could potentially derail spending cuts, how the administration seems to think that the way to resolve the deficit is partially through tax receipts, tariffs, which are a tax, and not cutting spending as much as we would like them to. We have been emphatic about this for, 18 months at least, that the only way to stabilize the debt is to get spending back on track to its 50-year median level of 20.5% of GDP. Any policy mix that keeps spending above that level will not resolve the deficit. The history is clear on this. Receipts have averaged 17.1% of GDP since World War II, subject to a small 0.8% standard deviation by each administration. So a myriad of different tax policies, and we still wind up with the same level of receipts. In order to stabilize the debt, not shrink it, just stabilize it, we need to get spending back to 20.5% of GDP. Well, the other piece of the policy mix right now that is disquieting is this mix of fiscal and monetary policy. And as I said, Powell seems to have dug in his heels around all this. So to begin with, we're in a little bit of a period of limbo. Congress is on recess, so we're not going to hear anything further about the mix between taxes and spending, potential corporate supply side tax cuts until they get back in at least another week's time. We won't hear the confirmation of Mickey Bowman as vice chair for supervision, and presumably the dropping of the capital proposal that Barr put forward, which should help the financial sector. They've accumulated a lot of excess capital. And we're still in this limbo period between what we're going to call sentiment-based data and activity data. It's all survey data. Okay, so this hard data, soft data stuff is nonsense, but we've obviously had a huge business confidence shock. We haven't seen the fallout from that yet. We may see it in this month's employment report. That would be the next big data set. So again, we're in somewhat of a period of limbo. We're waiting to hear big tech earnings, whether there's actually going to be any cuts there. We've clearly had a huge confidence shock that may impact orders for the cloud from big tech's customer base, right? So there's all this stuff that is not going to be resolved at least until next week when we get big tech earnings, Congress comes back from recess, and we start to see the labor market data. In that environment, retesting the lows wouldn't shock us. That's not our base case, but it's not a small probability either. And then we move on to the Fed. We thought Governor Waller did a good job detailing the potential scenarios now that President Trump has laid out the trade policy. So the Fed is able to frame this out, but yet Powell seems determined not to deal with the potential risks associated with this. In our view, all he needed to say is we've had a tremendous business confidence shock. We are on high alert for any deterioration around the employment part of our mandate, and not seem to be so obstinate and digging in his heels. And we think he's increasing the risk of a recession here. So we then went on to talk about term premium in the bond market, and this is belly week. We're going to get 69 billion of twos tomorrow, 70 billion of fives on Wednesday, 44 billion of 7-year treasuries on Thursday. In these weeks, the tendency has not been for the sell-off to be concentrated so much in the belly of the curve, but the back end of the curve has tended to sell off. And we're seeing that this morning with some bear steepening, weakness in 10s, 20s, and 30s. So that's something to keep your eye on this week. We think that the equal weighted part of the equity market is relatively cheap the cap weighted is still rich. That's still all about tech and those revisions. So that's, again, the big issue. And that's why we think the market could be vulnerable to aftershocks this week. So that's it for me, Barry Neff from Ironsides. Again, please consider becoming a full paid subscriber. There's lots of details in the note that'll really help you invest and think about risks. Barry from Ironsides. Have a good week. Thanks.